Should you buy individual stocks or simply invest through ETFs? For most investors, the sensible default is a diversified ETF. That answer may sound boring, especially when social media constantly highlights the one company that doubled, tripled, or became the next market obsession. But those stories usually begin after the winner is already known. They rarely show the hundreds of companies that disappointed investors, permanently declined, or simply failed to outperform a diversified portfolio. Buying an ETF means accepting the market's return, while reducing the importance of correctly identifying a small number of winning businesses. Choosing individual stocks means concentrating money in specific companies because you believe your analysis can produce a better result. That decision may offer greater upside, but it also creates more company-specific risk, more research work, and more opportunities for emotional mistakes. The real debate is not whether stocks or ETFs are universally better. Individual stocks are already held inside equity ETFs. The real question is whether you should accept diversified market exposure or deliberately increase your exposure to a few selected companies. To justify that decision, you need more than confidence. You need knowledge, valuation discipline, monitoring capacity, and a clear explanation of why the market may be mispricing the business. In this video, we will identify the situations where selecting individual companies can make sense, the situations where it probably does not, and how ETFs and stocks can coexist without turning the portfolio into a collection of random bets. Before comparing their performance, however, we need to clarify what an investor actually owns in each case. When you buy an individual stock, you purchase ownership in one specific company. Your investment result depends heavily on what happens inside that business. Revenue growth, profit margins, debt, competition, management decisions, and the price you paid can all materially affect the outcome. A major product failure, accounting problem, or competitive disruption can directly damage the entire investment. An equity ETF is different. You own shares of a fund, and that fund owns a portfolio of companies according to an index or investment strategy. Instead of relying on one business, your return reflects the combined performance of the underlying holdings, minus the fund's expenses. If one company experiences a serious problem, the effect may be diluted by the other holdings. That is the basic diversification advantage. But the ETF label does not automatically guarantee broad diversification. A total market ETF may hold thousands of companies. A sector ETF may depend heavily on one industry. A thematic ETF can concentrate money in a narrow investment story, and some funds are dominated by a small number of their largest holdings. So the correct comparison is not simply one stock versus any ETF. It is one company thesis versus the actual portfolio strategy inside the fund. An individual stock gives you direct control over which business you own and how much you own. A broad ETF gives you less control over individual holdings, but reduces the consequences of being wrong about one company. That trade-off explains why diversified ETFs should usually be the starting point for long-term investors.
Broad ETFs solve several difficult investment problems with one purchase. The first is diversification. Instead of needing to identify the future winners in advance, the investor owns a wide collection of companies and participates when some of them become exceptional businesses. The second advantage is simplicity. An investor does not need to study every quarterly earnings report, monitor management changes, or decide whether one disappointing year has permanently damaged the company. The portfolio still needs occasional review, but the maintenance burden is much lower. The third advantage is reduced company-specific risk. A single company can suffer from fraud, excessive debt, poor acquisitions, or technological disruption. Inside a properly diversified ETF, one failure is less likely to destroy the entire portfolio. The fourth advantage is automation. Broad ETFs are easy to combine with recurring contributions and a long investment horizon. The investor can focus on savings rate, asset allocation, and behavior instead of constantly searching for the next winner. But ETFs are not automatically safe or intelligently constructed. A highly concentrated technology fund, a leveraged ETF, or a fashionable thematic fund can create substantial risk. Some investors believe they are diversified because they own several ETFs, even though those funds hold many of the same companies. The advantage does not come from the letters E, T, and F. It comes from owning a well-designed portfolio at a reasonable cost. For most people, that is a strong foundation, and the statistical distribution of individual stock returns helps explain why replacing that foundation with a handful of companies can be much harder than it appears.
Stock market wealth is not created evenly across every listed company. Historically, a relatively small number of extraordinary businesses have generated a large portion of the market's total long-term wealth. Many other stocks produced weak results, disappeared through bankruptcy or acquisition, or failed to outperform very short-term government securities. One major global study examined nearly 62,000 stocks between 1990 and 2018. Within the United States, a majority of the individual stocks in the sample produced returns below one-month Treasury bills over their full available lifetimes. At the same time, a very small percentage of global firms accounted for all of the sample's net wealth creation above Treasury bills. These historical results do not tell us which companies will win in the future. They explain why stock selection is difficult. The investor is not choosing between an average company and an average ETF. The investor is attempting to identify the rare companies that can create extraordinary value while avoiding the many businesses that will deliver ordinary or disappointing outcomes. Diversification increases the probability that the portfolio will own at least some of those rare winners. A concentrated investor may correctly avoid several bad companies and still underperform, simply because the portfolio missed one exceptional business. This creates an uncomfortable reality. A market portfolio can benefit from companies that looked expensive, uncertain, or unimportant before they became dominant. A stock picker must own those companies before their success becomes obvious, or find different winners the market has not fully recognized, and even professional investors struggle to do that consistently. Professional fund managers have analysts, financial databases, access to corporate executives, and entire teams dedicated to researching companies. Even with those resources, consistently beating a broad index remains difficult. According to SP Viva data, 79% of active U.S. large-cap funds underperformed the S&P 500 during 2025. 1 year does not prove that active management never works. There will always be funds and individual investors that outperform during a particular period. The harder challenge is identifying them in advance and determining whether one successful year reflects repeatable skill, unusual market conditions, or simple luck. Performance must also survive fees, taxes, and trading decisions. A portfolio may outperform before costs, but provide no meaningful advantage after expenses. An investor may choose strong companies, but reduce the return by buying after enthusiasm has already pushed valuations too high. And the strategy that performs well for several years may still be abandoned during its first serious period of underperformance. Professional fund data is not identical to an individual selecting stocks in a personal account. An individual may have lower costs, greater patience, and the freedom to hold fewer companies. But the evidence demonstrates how high the competitive standard is. To beat the index, it is not enough to find the good company. The investor must find the company whose future results are better than the expectations already reflected in its price. That requires a real analytical advantage. So before choosing individual stocks, the investor should be able to explain what conditions make stock selection reasonable rather than merely exciting. Individual stock selection can make sense when 5 conditions are present. The first is a genuine circle of competence. You should understand how the company earns money, what drives customer demand, and which forces could damage the business. Using the company's product is not enough. A loyal customer can still misunderstand the economics of the business. The second condition is an analytical edge. You need a reason to believe that your interpretation of the company differs meaningfully from what the current market price assumes. The edge might come from deep industry knowledge, careful financial analysis, or a longer time horizon than other market participants.
The third condition is valuation discipline. A great business can still produce a poor investment result when purchased at a price that assumes perfection. The fourth condition is monitoring capacity. Owning an individual company means following its financial performance, competitive position, balance sheet, and management decisions. A stock cannot be treated as a permanent holding simply because it was researched once. The fifth condition is emotional discipline. You must be able to separate a falling stock price from a broken business thesis. Sometimes the market is temporarily pessimistic. Other times the company is genuinely deteriorating. Reacting automatically in either direction can be expensive. Missing one of these conditions does not make someone a bad investor. It may simply mean that a broad ETF is the more appropriate tool. But when all five conditions exist, selecting an individual company can become a disciplined investment decision rather than a guess. That discipline begins with a structured research process. Before buying an individual stock, start with the business model. How does the company make money? Which products or services generate revenue? And which customers ultimately pay for them? Next, examine the competitive advantage. Does the company have a strong brand, lower costs, network effects, customer switching costs, or intellectual property that competitors cannot easily reproduce? Then study financial quality. Revenue growth matters, but growth without durable margins or cash flow can destroy shareholder value. Review profitability, free cash flow, and whether earnings are supported by the actual economics of the business. The balance sheet is equally important. A company with excessive debt may appear healthy during favorable conditions, but become vulnerable when interest costs rise or revenue weakens. Management must also be evaluated. Look at how executives allocate capital. Do they reinvest intelligently, make disciplined acquisitions, and repurchase shares at reasonable prices? Or do they repeatedly issue stock, overpay for growth, and change the company's narrative whenever results disappoint? Finally, estimate valuation. What revenue growth, margins, and future cash flows must occur to justify the current stock price? The objective is not to calculate one perfectly precise value. It is to understand which expectations you are paying for. Every stock thesis should also contain a clear failure case. What could permanently damage the competitive advantage? What evidence would prove the original analysis wrong? Once those questions are answered, the company can be evaluated as an investment. And this is the right point to clarify the kind of investing analysis this channel is designed to provide. If you prefer stock analysis built around businesses, valuation, and portfolio risk instead of lists of guaranteed winners, subscribe to Boring Money Wins. The purpose of individual stock research is not to create a more exciting portfolio. It is to determine whether a specific opportunity justifies taking more concentrated risk than a diversified ETF. That requires understanding the company, estimating what the market price already assumes, and defining what would invalidate the investment thesis. It also means being honest when no real advantage exists. Sometimes the intelligent conclusion after hours of research is simply to continue buying the broad ETF. If this approach is helping you separate disciplined stock selection from ticker collecting, click the like button. That helps YouTube recommend the video to more investors searching for a realistic comparison between stocks and ETFs. The channel is not based on blind ETF worship either. ETFs can be expensive, concentrated, or poorly designed. Individual companies can produce exceptional returns when purchased with a sound thesis and controlled position size. The objective is to choose the right tool for the job. And for investors who want both diversified market exposure and a limited opportunity to apply active analysis, there is no requirement to choose only one side. A core satellite portfolio can combine a stable ETF foundation with a smaller allocation to carefully selected companies. A core satellite portfolio uses diversified ETFs as the foundation and individual stocks as smaller positions around that core.
The ETF portion provides broad market exposure, diversification, and a place for regular automatic contributions. The stock portion allows the investor to express a limited number of high-conviction ideas without making the entire retirement plan depend on them. An illustrative portfolio might hold 80 to 95% in diversified ETFs and 5 to 20% in individual companies. Those percentages are not universal recommendations. The correct allocation depends on experience, financial goals, risk tolerance, and how much underperformance the investor can accept without abandoning the strategy. The central rule is that the satellite positions should not be large enough to destroy the core. If one stock fails completely, the diversified foundation should remain capable of supporting the long-term plan. This approach also creates an honest performance comparison. The investor can evaluate whether the individual stock decisions are actually adding value relative to simply owning the ETF. Without that comparison, a stock picker may celebrate the winners while ignoring the capital tied up in weaker selections. A small active allocation can also serve as an educational budget. The investor gains experience reading financial statements and testing investment theses while limiting the financial consequences of early mistakes. But owning 10 poorly researched companies is not automatically safer than owning 3 carefully studied businesses. The number of stocks matters less than their position sizes, correlations, and the investor's understanding of each company. That is why portfolio construction should begin with risk sizing before the investor begins imagining potential gains.
A good company can still become a dangerous investment when the position is too large. Consider 2 simplified portfolios. In the first, one stock represents 5% of the portfolio. If that stock falls by 50%, the direct portfolio impact is approximately 2.5%. The loss is uncomfortable, but the broader plan remains intact. In the second portfolio, the same company represents 20%. A 50% decline now reduces the entire portfolio by approximately 10%. The company did not change. The position size changed the financial consequence of being wrong. Position size should reflect thesis confidence, downside risk, business stability, and correlation with the rest of the portfolio. A cyclical company with substantial debt may deserve a smaller position than a financially strong business with recurring revenue. Personal circumstances matter too. An employee who receives salary, bonuses, and company stock from one employer already has significant economic exposure to that business. Buying more of the same company inside a retirement portfolio can create double concentration. If the company struggles, the investor could face a declining stock price at the same time job security weakens. Position sizing cannot eliminate investment risk. It prevents one analytical mistake from controlling the entire portfolio. An investor should decide the maximum tolerable loss before becoming emotionally attached to the potential upside. This is especially important because even correctly identifying an excellent company does not guarantee an excellent stock return. The purchase price still matters. A company and its stock are related, but they are not the same investment question. A great company may have loyal customers, strong margins, and excellent management, but if the stock price already assumes years of perfect execution, even good business results may disappoint investors. Investment return is influenced by business performance, dividends, and changes in valuation. Imagine 2 investors buying the same high-quality company at different prices. The first investor purchases when expectations are reasonable, the company performs well, and the valuation remains stable. That investor may receive an attractive return. The second investor buys after enthusiasm has pushed the price to an extreme level. The company continues growing, but slightly slower than the market expected. The business remains excellent, yet the stock declines because the valuation contracts. Nothing fraudulent or catastrophic needs to happen. The company only needs to perform below the expectations embedded in the purchase price. This is why statements such as "I believe in the company" are incomplete. The relevant questions are how much growth the price assumes, whether those assumptions are realistic, and what return remains if the future is merely good rather than extraordinary. Valuation is not a precise timing tool. An expensive stock can become more expensive. A cheap stock can remain cheap because the business is deteriorating. But ignoring valuation means ignoring the connection between the company's future cash flows and the price paid for them.
Once a company is purchased, the investor also needs a process for determining whether new evidence supports the original thesis or whether it is time to sell.
A disciplined stock thesis should include the conditions that would cause the investor to reduce or sell the position. The first valid reason is that the business thesis has broken. Perhaps the competitive advantage is weakening, customers are leaving, or new technology is making the company's product less relevant. The second is financial deterioration. Rising debt, collapsing margins, or consistently weak cash flow may demonstrate that the economics are worse than originally expected. The third is destructive capital allocation. Management may overpay for acquisitions, issue excessive stock, or invest shareholder money in projects that fail to earn reasonable returns. The fourth reason is valuation. A stock can rise so far above a reasonable estimate of future value that the potential return becomes unattractive relative to the risk. A falling price by itself is not necessarily a reason to sell. Neither is one negative headline or a wave of social media panic. The question is whether the new information changes the company's long-term earning power or reveals that the original analysis was wrong. But the opposite mistake is equally dangerous. Long-term investing does not mean refusing to change your mind. Holding a deteriorating business forever is not patience, it is avoidance. The investor should document the original thesis, compare it with new evidence, and decide whether to hold, reduce, or exit based on the facts. This process requires time and emotional control. Investors who have no interest in maintaining it may be better served by diversified ETFs, and several other warning signs point toward the same conclusion. Individual stock selection is probably not appropriate for someone who has no time or interest in researching businesses. Reading financial statements is not the only form of analysis, but investors should at least understand revenue, debt, profitability, and cash flow before concentrating money in one company. Stock picking is also dangerous when decisions are driven primarily by social media excitement, recent price performance, or fear of missing out. By the time a company becomes an obvious online favorite, the valuation may already reflect an extremely optimistic future. Investors who panic during normal market declines may also struggle with individual stocks. Company prices can move far more dramatically than a broad index, even when the long-term thesis remains intact. Without position size rules, one exciting idea can gradually become the majority of the portfolio. That is especially risky when retirement, education, or other essential financial goals depend on the money. Concentration can become even more dangerous when the investor's job, bonus, and portfolio all depend on the same employer or industry. In these situations, automated broad ETF investing is not an admission of defeat. It is often intelligent portfolio design. The investor exchanges the small possibility of outperforming through a few selections for a higher probability of capturing the long-term returns of the broader market. A simple strategy also reduces the number of behavioral decisions that can go wrong. The purpose of investing is not to demonstrate intelligence by owning complicated assets. It is to build wealth with a process that can survive uncertainty. That brings us to the final decision framework for choosing between stocks and ETFs. So when should you actually pick individual companies instead of relying entirely on ETFs? For most investors, broad diversified ETFs should remain the default. They offer efficient diversification, lower maintenance, and a greater probability of owning the market's rare long-term winners. Individual stocks should be considered only when the investor has a repeatable analytical process. You should understand the business, evaluate its financial strength, estimate a reasonable valuation, and identify the risks that could break the thesis. You must also control position size and remain willing to monitor the company after the purchase. Before buying, ask 5 questions. What is my analytical edge? What is the business reasonably worth? What could permanently damage the investment thesis? How large can the position become without threatening the portfolio? And what evidence would make me sell? When those questions cannot be answered, the ETF is probably the more rational choice. When they can be answered with evidence, an individual company may earn a controlled position. A core satellite approach can provide a practical middle ground. Use diversified ETFs for the financial foundation and reserve a limited allocation for companies where the research genuinely supports greater conviction. The objective is not to beat the market every quarter, it is to take active risk only when the potential reward justifies the additional concentration, work, and possibility of underperformance. Start diversified, demand evidence, control concentration, respect valuation, and keep the core boring. Because boring money wins.